The stock for Safe and Green Holdings Corp, ticker SGBX, is trading live at $4.32, marking a significant plus 25.76% move up in the current trading session. This kind of explosive single-day move in a stock with a volatile history immediately creates a tension between expectation and reality. The surface expectation is that a nearly 26% jump must be linked to some major news, a massive contract win, an unexpectedly strong earnings report, or perhaps a significant corporate action like a stock split announcement. However, the immediate reality we observe is a technical surge driven by extremely high relative volume, nearly 3 times the average daily volume on the back of a small public float. This suggests the move is less about a single fundamental bombshell dropping today and more about a short-term, high-momentum trading dynamic that's pulling price higher, which is a key distinction that long-term investors need to grasp when they are looking at such massive price spikes in a small-cap name. The common market narrative here, especially in the online investment communities and self-investing forums where stocks like this are discussed, is often focused entirely on this momentum, treating SGBX as a high-risk, high-reward trading vehicle. Many individual brokerage accounts hold this purely for the volatility, hoping to catch a big swing. But what we need to challenge is whether there is any underlying substance, a fundamental shift, to support this type of sharp appreciation, or if this is another one of those transient moves we see so often in stocks with low market capitalization and high short interest ratios, making it sensitive to short covering rallies and retail investor speculation, similar to what we've seen happen with other highly traded names on platforms like Robinhood. Looking closely at the recent tape, the stock's price has been incredibly erratic over the past month, trading from the high 3s down to the low 2s and now bouncing back aggressively. This kind of volatility is the reality of trading SGBX, which stands in stark contrast to the expectation of a steady, fundamentally driven builder of modular facilities. The core business involves the design and construction of modular structures using code-engineered cargo shipping containers and wood for residential and commercial use. This is a business tied to the construction and real estate development sector, which generally speaking moves at a deliberate, measured pace. Yet the stock is trading like a hyper-growth tech stock. This gap is the most important part of the SGBX story right now. In late October, we saw a massive volume spike and a large percentage gain on the announcement of an aggressive drilling agenda slated for Q4 of this year and expansion throughout 2026 for its subsidiary, Olenox Energy. That news, which injected an energy component into a construction-focused company, was the clear catalyst for a previous wave of speculation. The current surge is likely a delayed reaction or a continuation of that momentum, possibly coupled with a technical breakout from its recent range, rather than fresh news. Institutional ownership is minimal, holding only a fraction of the outstanding shares, which means big banks and traditional Fidelity Investments or Interactive Brokers platform users are largely sitting on the sidelines. This lack of institutional presence is precisely why the stock is so susceptible to the fast, dramatic moves driven by a concentrated group of retail traders operating in the online investing space. When the big institutional money is small, the smaller retail investors' activity has a much larger impact. The company's structure is also a point of necessary complexity that challenges simple investment expectations. Safe and Green Holdings operates through multiple segments: construction, which includes manufacturing modular units; medical, which has historically focused on turnkey solutions like mobile COVID-19 testing facilities; development, which handles real estate projects; and a newly emphasized environmental segment. The recent spin-off of its subsidiary, Safe and Green Development Corporation, SGBX's prior entity, was an effort to isolate the real estate development assets from the modular construction operations, presumably to unlock value and provide clearer financial reporting for each part of the business. Often, corporate actions like this are expected to immediately lead to a cleaner balance sheet and clearer valuation. But for SGBX, the reality has been continued complexity and volatility. The development segment, with its property development, creates a heavy capital expectation, while the core construction business is project-based and cyclical. Investors looking for a pure play on modular construction are instead getting a complex mix that includes an Olenox Energy subsidiary talking about drilling. The market seems to be reacting to the idea of expansion and the potential of the energy subsidiary, overlooking the historical reality of net losses and negative cash flow from operations, which were clearly evident in their most recent financial reports. For those using tools like Schwab Intelligent Portfolios or a SoFi Invest account to screen for fundamentally sound growth stocks, the numbers likely screen poorly, forcing a strictly speculative approach. Let's ground this high-flying stock in its fundamentals for a moment. The financials, which represent the concrete reality of the business, show ongoing challenges. Revenue for the company has been under pressure, and the company has been consistently reporting net losses. The most recent quarter demonstrated a year-over-year decline in revenue, coupled with an increase in total assets, but also a complex and rapidly changing equity structure. For a smaller company, financing and share management are critical pressure points. There's always a lingering question of dilution in a small-cap name with high growth ambitions but limited cash flow. This is the ultimate tension for SGBX. The expectation of high growth from sustainable modular construction and energy exposure versus the reality of a thin cash position and a history of shareholder dilution, which can pressure the price over the long term, regardless of the short-term volume spikes. The volatility we see today is a mirror of this internal tension. Traders are piling in on momentum while value investors see the financial metrics and walk away, preferring the predictability of Fidelity mutual funds or low-cost Fidelity ETFs. This dichotomy is what drives the extreme price swings. The key to understanding the recent momentum is to focus on the structure of the stock itself. The low public float means that a relatively small amount of trading volume can exert an outsized influence on the price. This is the classic setup for a crowd wave, where technical buying triggers stop losses and short covering, leading to a parabolic move that is self-reinforcing until the buying pressure subsides or a significant selling event occurs. Given the reported short interest, the potential for a short squeeze is always a palpable risk and a clear incentive for those using Robinhood stock trading to play the momentum. But these technical squeezes are often fleeting. The challenge for any investor buying SGBX at this moment at a near 26% intraday premium is determining whether the price is simply reflecting a short-term mechanical phenomenon or if the market has actually begun to price in a higher value based on the future execution of the modular construction pipeline and the energy subsidiary's announced drilling schedule. Without a clear, massive contract announcement, the bias leans towards the former. The outlook for Safe and Green Holdings is entirely dependent on execution in two very distinct sectors. The construction side needs to secure large, profitable contracts that can actually translate revenue into positive net income. Modular construction remains an attractive concept, particularly for disaster relief, temporary housing, and quick-to-market commercial builds, which plays into the narrative of green and efficient building. The Tesla stock story, while in a completely different sector, demonstrates how the market can apply a premium to a company that executes on a genuinely transformative vision, even if traditional metrics lag. SGBX is hoping to catch a fraction of that narrative in the building space. Secondly, the energy subsidiary, Olenox, needs to show concrete progress with its drilling plans and its AI-powered wellsite monitoring system. This push into energy, while diversifying, also adds execution risk and the requirement for a new layer of expertise. The market will soon stop listening to press releases about aggressive schedules and start looking for permits, actual drilling commencement, and, most importantly, revenue from those operations. If they can execute on both fronts, the reality of their business could finally start to justify some of the volatility-driven expectations. But if they stumble, the price will likely retreat to levels more consistent with the current financial reality of a company with negative earnings and a small market cap. For those engaging in online investing and seeking investment help, SGBX is prime example of why an intelligent portfolio approach needs a layer of human-guided due diligence. Automated advice from a service like a Schwab Intelligent Portfolios or a SoFi Invest account might flag the extreme volatility and poor fundamental ratios, potentially classifying it as an unsuitable holding, but it wouldn't capture the subtle, momentum-driven narrative currently fueling the price. This stock is truly for active, self-investing individuals who are comfortable with the risk profile of high-volume, low-float small caps. It serves as a strong reminder that the individual brokerage experience, whether on a platform like Robinhood or the more sophisticated